Okay, good afternoon, everybody. Thank you so much for joining the webinar. Thank you to Roth& Company and the OJC Fund for sponsoring and bringing this webinar. We're going to be talking about the year-end charity tips for maximizing your tax benefits. My name is Aaron Pinson. I'm the founder and chief investment officer of Equinum Wealth Management. And I want to start out by saying that nothing discussed today should be construed or thought at as professional investment advice, nor tax advice, especially as it relates to charity and deductions. Every single person's situation is different. And that's important to recognize, as some of the things we're talking about here may be applicable for some, not for others. So please consult your own professional advisors, whether it's tax or investment professionals. I'd like to introduce the two co-panelists here with me. Mendy Weg is a Roth&Co partner, brings over 12 years of managerial experience, skilled proficiency in providing essential tax compliance, review services for the firm's clients, and he deals with a lot of the firm's clients as it relates to real estate and investment funds. And Yisrael Kilstein is a manager at the Roth&Co non-for-profit services department. He serves charities, schools, religious institutions, and other nonprofit entities, and guides them for the reporting obligations, compliance issues, initial structuring, and in general, providing consulting services. I do want to encourage everybody. There is a Q&A function to this chat. I see already a couple things actually came in already. So please use that function. We're going to try to make this as interactive as possible. So if there are any questions, we'll try to address them as we go through the webinar, whether it's general questions or specific questions as it relates to some of the things we're discussing. Okay, so just a brief overview of the webinar today. So we'll be discussing the overall tax benefits of charity. So a lot of people here, I'm sure, are joining, give charity and tzedakah, whether it's 10%, 20% of income. There is a thought process that you could have two sets of books and records as it relates to these types of giving. One is just according to your income and according to different beliefs that you have. From a tax perspective, that books and records that you're keeping could be very different, whether it's the timing of the donations you're giving, to who you're giving, how you're giving, what is considered charity, what isn't. So we're going to talk about some of these qualifying characteristics of what is considered charity to be able to maximize your deductions. Towards the end of the conversation, we're actually going to give some kind of examples or strategies of really, even in some cases, a win-win scenario of being, gifting some appreciated securities or appreciated assets. So you not only can get a deduction for the charity perspective, but you can also get a tax deduction or a save from from getting any sales from getting any capital gains taxes as well. So we're going to discuss who can get a deduction, how much you can deduct. Very importantly, there's differences in what you're giving and to whom you're giving and how much you can deduct off a person's income. So without further ado, I do want to introduce, just move it over to Mendy, who's going to discuss some of the background of charitable giving and some of the things we mentioned a second ago.
Thank you, Aaron, and welcome everybody to the webinar. So I'll start just from some basic points, and then we'll get into more details as we move along. So the purpose why the charitable giving is in the IRS code has to do with the fact that the government does realize the good duties that all the charitable organizations do out there. And this helps incentivize people to give more charity. And that's the main driver behind this overall deduction that's part of that's within the tax code. So the question is, who benefits from giving charity, which type of entities? And practically everybody benefits. Again, there's limitations, which we'll get into. But we'll focus mainly on individual taxpayers, but do keep in mind that there's a benefit for corporations and other entities as well that would get a benefit. And the benefit is it reduces taxable income. We're going to go through a very simple example just to illustrate how it works. So we'll get there in a minute. But I just wanted to point out, as far as limitations are concerned, that it's from a broad perspective, it depends what type of charity it is. If it's a public charity, you will limit 60% of your current year income. With the private charity, it would be 30%. And when it comes to foreign charities, they get a little complicated. It's generally not deductible, but there are some exceptions.
Okay, as it relates to actually the public charities, but foreign ones. Mendy, could you go into maybe some detail, or maybe Stroll, you can chime in. I know probably a lot of people on this webinar have charities or interests of giving charity to maybe countries like Israel. I see foreign charities are generally not deductible. It could be. Could you maybe give an example specifically as it relates to Israel or Israeli charity and how you see that playing out?
Okay, I'll take that. Thank you, Aaron. Foreign charities, as mentioned, is generally not deductible. There are tax treaties with 3 countries, Mexico, Canada, and Israel, that you can receive a tax deduction to a qualified charity that's based out of those countries. However, that is limited to your income sourced from those countries, meaning if you're investing in a business in Israel and receive income from source to Israel, even though it's taxed in the US as well, since the US taxes on worldwide income, if you do give a charity directly to an Israeli organization, you would be able to get a deduction against that income. However, most Israeli charities do have American Friends of type organizations, so American Arms, so to speak, where you can give a donation through there, where you have an increased benefit so you can offset all your income, not specifically Israeli sourced income. So it's always advisable to try to give it to a US-based organization.
Excellent. Thank you, Yisrael. Mendy, could you continue with maybe an example? So I have a couple of slides of an example of the typical standard way of deducting charity.
Sure. So we picked a very straightforward example. If you have a married couple that has $1 million of income, and with the way it works is the way the IRS code is set up, you get a standard deduction. So taking 2023 as an example, for 2024, keep in mind that deduction does go up with inflation every year. But for 2023, there was 27,700. So that's something that the IRS does give you as a option to take a standard deduction. And the other option potentially, which includes a charity, which is what we're covering here, would be to itemize. And when you itemize, you're pretty much saying that you do not want to go with a standard deduction. You want to use other items instead. And the main items is generally mortgage interest, property tax, and charity. So the example here is $10,000 of mortgage interest, $10,000 of property tax, and $80,000 of charity. So those are the 2 options you have. And then going to this slide over here, you see the summary, $1 million of income. You have the option of either taking the standard deduction of 27 grand or the itemized deduction of $100,000. And then the summary over here is very simple. You have $1 million of income. You either go with the standard, which brings you down to $972,000 of income, or if you go with the itemized deduction, which includes a charity, that would get you to $900,000 of income. And then the overall tax savings by going with this itemized deduction would be $26,000. Now, a couple of things to keep in mind. We're giving a very simple example here because we're focusing on just the point of itemizing versus standard. I know there's probably accountants listening that know that tax returns are much more complex, but this is the focus here, is really focusing on the charity and how it affects the standard versus itemized deduction. And one other thing to point out is that at $1 million of income, your tax rate is 37%. And so that what that means is that for every $100 of additional charity you'd give, you would save $37 of federal taxes. Again, states could be more depending on what state you live in, but that's just a short summary of how giving charity would reduce your taxable income.
Okay, thanks so much, Mendy. We'll get back to you shortly. Yisrael, let's shift over to you, and let's maybe review some of the qualifications and requirements to receive the deductions. If you can maybe give some examples as you're reviewing some of these things of different assets that you're donating and things that are necessary as a requirement.
Sure. Okay, so let's start off with what kind of organizations or where you can give charity in order to get the deduction. As a general rule, it has to be a registered 501c3 or other type of organization, meaning not specifically 501c3, but generally they're 501c3s. You can't give to an individual, no matter how needy the individual actually is, that wouldn't be considered tax deductible. It has to go through a registered charity for the most part. There are some organizations, such as religious organizations, such as a congregation or similar organizations that provide religious services, that are exempt from registering with the IRS, even though they do register. For the most part, most of them would register. The IRS has a useful website where you can check up if the organization is registered with them and what kind of organization it is. As we mentioned briefly, there are differences in what kind of classification the organization has. However,
So just to clarify that point, so you could have a congregation that is a 501c3 as well, and you said most do register, but you could also have a congregation. So for my local show, it says, oh, I went to the IRS website and I typed in your name and it's not showing up. It's possible that they're still registered as a congregation and I could get a receipt, or would I for sure be able to find them on a website somewhere that they are a registered organization of a congregation of sorts that I can get that receipt from?
No, you're correct. So congregation is not required to register, and they are considered 501c3s regardless, as long as they are performing religious services. So a lot of local, smaller congregations don't bother to register, and as long as you know and you can show that they actually are providing religious services, then they are eligible to give a receipt and you to deduct that contribution that you gave to that organization, even if it's not registered.
Okay, so I also have two questions came in on this point specifically. So 501c3 classified, are they considered public or a private charity? Someone asked that.
Okay, so 501c3 is a general classification for any charitable organization that falls into three categories of charitable, religious, or meaning that kind of category. Anything, there are other types of organizations, 501c4, 6, 5, 21, there's all different types of organizations. However, for the most part, what we're talking about are all 501c3 organizations, no matter if they're public or private, they're still 501c3s, and that's not the criteria that we're really going to be talking about. So
Okay.
meaning everything we're talking about for the most part are 501c3s or other eligible Cs, code sections that are.
Okay, so someone asked on a follow-on a similar type of question, a rabbi's discretionary fund. Is that also something like a private type, or do you know what that is?
I don't know what that is, meaning that's just a designation, seems more. It still has to be organized as a specific type of organization, either a 501c3 or it's a branch of your local congregation and not really a separate entity. It's
Okay.
just a designation by the board.
Okay.
Okay, what can be donated? Now, almost anything can be donated as long as it's tangible. Intangible, for the most part, can't be. There are some exceptions. So what tangible means would mean anything from cash to securities to property to appreciated assets, real estate, anything, almost anything can be donated. There are differences in the amount you can deduct based on that, but almost anything can be donated.
So if I have a private business and I want to donate a portion of my private business, theoretically, I can do that?
Correct. We'll get into it. You might have to have it evaluated and appraised, but yes, you can donate that and get a deduction for that. In order to get a deduction, there are some qualifications. One of them is that it can be in exchange for something, meaning if you have a prior obligation, paying off that obligation is not entitled you to a deduction, and you can't receive a benefit. What that would usually mean is a benefit. For an example, a congregation or a school holds a dinner where they serve a meal, entertainment. The portion of the ticket price that goes to cover that is not deductible. So for an example, if the ticket price to attend is $360, and the estimated fair market value of the meal and the entertainment is $70, you'd only be entitled to a deduction of $290. The organization is required to write that on the receipt to give a fair market estimate of the value of benefit received. So they would write, let's say, $90 was the fair market value of the benefit, and you're eligible for a deduction of $290. Related to that, receiving a benefit, certain things are not considered a benefit. So there are some de minimis amounts, which we're not going to go into. That changes every year, the amounts for that. More common question that we get very often is religious benefit, which would mean membership dues, which by paying the membership due, you get the privilege of attending services in the congregation, or an aliyah, for example, which is considered an intangible religious benefit, and you would be eligible to receive the full deduction on the amount donated to cover membership fees or the aliyah. However, that is only if the membership dues only entitle you to participate in religious services. If there's any other side benefits as well, that might have to be deducted depending on circumstances. Going a little deeper into additional qualifications needed to receive the benefit, you do need a written record for most donations. Any donation below $250, you don't need a receipt. However, you do need a written record, which per the IRS would bank statement would be sufficient as long as it shows the date of the donation, the amount donated, and the name of the organization. Donation above $250 needs a contemporaneous written acknowledgement. We'll go into that a little more, what that means, but that's generally covered with a receipt that organizations give. For non-cash donations, there can be more additional requirements. For any value above $500, you would need to attach a 8283 to your return, and for non-cash donations with a value of above 5,000 or a group of similar items with a value above 5,000, you would need a qualified appraisal and have to attach that appraisal to your 8283 and attach it to your return.
So I doubt my wife's listening to this call, so I'll mention it. So if I want to donate her watch or something like that, and I think it's worth, I don't know, $10,000, it's over $5,000. So at that point, it has to be appraised first. I can't just say, oh, this is the purchase price. It could be a value. How does that work?
Correct. So you'll need to have it appraised. Not necessarily you need it before, but it does need to be, we'll go into the deadlines in a minute, but you would have to have an appraisal done right away, and to assign a value to the donation. Now, an organization cannot provide a value for any non-cash item. The IRS specifically does not allow the organization to write it. We get it a lot of times from organizations that donors are insisting on them telling them how much it was worth, showing them invoices. The IRS does not allow an organization to write it, no matter how much proof they're provided with. They are not allowed to assign a value. The only thing they're allowed to write on the receipt is what was received.
Okay, I do have a bunch of questions, and I want to mention it again. There is a Q&A function. We have 5 or 6 questions that came in, and I do want to make this interactive instead of a Q&A in the end. So please utilize that function, and I'm going to get into a couple of them. One we answered already, which we said buying an aliyah or something like that initial, is it deductible or not?
An aliyah would be deductible. That's considered an intangible religious benefit. The only thing you're receiving is, the honor of reading.
So an aliyah is considered an intangible benefit, so it doesn't have to be marked down. There's no, like, I could resell the aliyah afterwards. Theoretically, let's say it's Yom Kippur or Rosh Hashanah, which aliyah could be go for who knows how many thousands of dollars, depending on which shul you're going to. But you're saying that no matter the cost of it and the resale value, it's considered an intangible benefit.
I don't want to go into that. If there's a resale value, it might be a little different, and especially if you do sell it, you might have to pick up income. We wouldn't go into that. But for the most part, aliyah is considered intangible religious benefit, and the main reason for giving the bidding on the aliyah would be just in order to give a donation, and no side benefits other than a religious benefit.
Okay, Art is asking, how about a credit card statement? I'm assuming this means about proof, as not having a receipt, but it just shows on the credit card. How about that?
So a credit card statement would be good for under $250. That's considered a written record, as long as it says the name of the organization or somehow to decipher the name of the organization, I guess. But if it doesn't have the full name, but at least something. But that's only for below $250. Above $250, you do need a written receipt from.
Got you. Okay, Mendy, I think this was on yours a slide earlier, but it just came in now. But what's considered public and private charities for the 60 and 30%? How do you decipher between that of what's considered public versus private?
Generally speaking, a private foundation is considered private. That's what we've seen, that's what we've seen historically. And a public is just a general nonprofit that has welfare organizations. So I think you have to look at I think it does take some time to dig a little bit deeper to make sure that you know what you're giving to and what your limitations are.
Just to jump in there, a public charity, for basic definition, is receiving, they receive their funds from the general public, and private is usually a family foundation or receiving the funding from one company, one individual, or family of individuals.
Okay, and then I think this is a point to clarify, and one of the questions coming in, or it's actually multiple times, as far as $250, is it per donation or is it per organization? So if I want to give $200 per, 5 different contributions of $200 to the same show within a week, who knows how many times, is that considered $1,000 or is it considered $200?
Anything below 250 per transaction, I believe it is, would not require. So if you do split it up, there might be a way to get around it. I doubt the IRS would like that, but per the rules, that's what it is.
Okay, and then I'm gonna take one of them myself here. So there's a couple of questions that came in that we spoke about earlier, but as far as the difference between itemizing deductions and standard, so there is a breakdown, and this is going to be, every person is going to be dependent on their specific situation. So there's no rule of thumb of, okay, this is when you should itemize deductions, this is when you should go with the standard. It's really going to depend on your specific situation. So there's no minimum. Another question came in: is there minimum income to able to deduct to charity? There is no. Again, every person's situation is different of when you should be able to use that itemized deduction to deduct, because the standard deduction, especially in lower income individuals, a standard deduction, even if you're giving a huge percentage of it, may not be,
Right.
may not be worth
just
it.
to jump in, I think maybe the question was, or could be potentially, what happens if your income is minimal and therefore you not paying any taxes regardless? Is there any point of itemizing? So I think that's really the question potentially, and at that point you're not really going to benefit from charity, and that's a question that we do get sometimes. My income this year is very low. Is charity going to help me this year? And the answer is, it will not help you in the current year because of the fact that you're not paying any taxes. So you might not be necessary.
Okay, perfect. So let's move on. There are a bunch more questions, and again, please continue asking. We'll try to get them selective, but we do want to finish the prepared remarks as well. So let's move on. Yisrael, if you could please clarify, maybe as far as this slide, as it relates to just the deadlines that are available or that are required, as far as, especially end of the year, just a couple weeks left. What are the deadlines as it relates to charitable giving for 2024?
Okay, thank you. That related to deadlines to actually making the contribution. As I'm sure everybody knows, the year finishes at December 31st. Contribution has to be given by that date. However, what is considered given and in order for it to be deductible within 2024? For checks, it's very simple. The IRS has the mailbox rule, which means that as long as a check is in the mailbox and postmarked by the December 31st, you would be eligible for deduction within 2024. That does not include FedEx or UPS. It has to be for the U.S. Postal Service, postmarked by them. However, in today's days, that's not as relevant anymore. Most people do not mail out checks anymore, and most of it is done through ACH. And that is the IRS has not released direct guidance, but other code sections the IRS considers a withdrawal to be happening on the date that it shows in your bank as withdrawn from your account. So if your bank initiates ACHs and they take it out of your account within the same business day, then you can do it at 12/31, even though the organization won't receive it, especially if it's in another banking institution. They wouldn't receive it till another few business days. It is considered as given within 2024. However, if your bank does take a day to process your ACHs and it shows up on your bank statement or online account as being withdrawn on the next day, on the 1st or on the 2nd even, because it's a bank holiday, then it would not be eligible for a deduction.
Okay.
Most other things are similar. Stocks are, if it's mailed out, the certificate is mailed out, it will be the same time. If you're changing the owner of record, that's usually a longer process, and it's the same thing. It would be the date that it's shown as coming out of your account, or the record is switched, which usually takes longer.
Okay, so you're saying a date on a check, even if I show a check that maybe was only cashed on January 15th, or let alone February or March, but if I show the date on it shows December 23rd or who knows what, that's not going to be enough.
Not going to be enough. No, you need a postmark.
Okay, excellent. So thank you, thanks, Israel. Let's move back to Mendy, and I want to preface this slide by
Aaron,
saying,
before we go further, I would want to get back into CWA, which is the contemporaneous written acknowledgement, which is very important because the IRS does disallow deductions if you cannot show that you had it. It's required to be received by the taxpayer from the organization, and it needs to include the phrase "no goods or services provided," or if there was something, then the value of what was provided, and if it doesn't, the IRS will disallow it, even though it has all the other qualifications, date, amount, organization name, EIN, everything. If it doesn't have it, then they will not allow you to take the deduction. And even if you correct it at a later point, it's too late because you have to receive this written acknowledgement by the earlier of the date you filed the return or the due date, including extensions. And if you can't show that you had it at that point with all the qualifications needed, they will disallow that deduction.
okay, thank you, Israel. So someone's actually asking an interesting question. So do you need to file and have the like when you're filing, show the receipts, or is it sufficient that if and when they do get audited, that they have to provide the receipts, or is it part of the actual filing process?
No, it's not required to be shown to anyone. You have to have it in your record, and if you get audited, you're going to have to show that you actually had it at that point, not when you get audited.
Perfect. Thank you so much. So I just want to preface this slide. I'm going to take back, I think, Mendy, you're going to take over for this slide. So as an investment advisor and manager for clients, this is probably the question that is most pertinent, and especially as it relates to the next couple of weeks, people are running and trying to maybe get an extra deduction here and there. Should they open up their own private foundation, or should they give money to a company like OJC, one of the donor advised funds? And what are the differences in what they can do? So why don't we get into maybe first off, as far as how much could be donated, and maybe after that, maybe some of the differences between the charities. Mendy, why don't you take it over from here?
Sure. So if you donate in cash, the limitations is pretty straightforward. It's 60% of your current year adjusted income for public charity and 30% for a private foundation.
Okay, and in this case, is a donor advised fund considered a public charity in all regards, or is it kind of like a private?
It's considered a public charity, so it would go with the 60% limitation. And jumping over here, this comes up a lot. There's a lot of questions related to this. Has to do with non-cash donations. So it does the limitation. You are more limited when it comes to non-cash donations. That's something you should keep in mind. And again, depending if it's public charity versus non, that also would change the percent of the current year income that you're allowed to deduct.
Just to clarify over there, there's a difference between between capital assets and non-capital assets. I'm not going to go into the specific differences, but ordinary income, meaning something that you have in your business, you use in your business, let's say inventory or something like that, would be a non-capital asset. Something you hold for investment purposes is usually considered a capital asset. Where you receive, we'll go more in detail later, but you can receive an additional benefit by donating a capital asset, appreciated capital asset.
Okay, so I know, Aaron, you had mentioned a little bit of this, but we'll go into it a little more detail, and I'll share with you some of these points. But this is really a lot of questions that come throughout the year, especially at year end, which is, should I open a private foundation? And the question could be, should I open it's very simple. I have a lot of charity to give. Does it make sense for me to open a private foundation? Another couple of questions related to that has to do with the record keeping. Like we just covered a couple slides ago, there's a lot of potential records you have to keep. We said you file the return, you don't submit the receipts with the return. You have to keep those records. That's another challenge that people call and ask about, like how to keep records. It's hard to keep records for so many years. Another thing also that people do ask when they have a significant amount of charity, they don't want to distribute all the charity at once. They want to potentially invest it. So those are the questions that come about, and usually the first thought process, again, thought process has changed over the past few years, but back in the day, it was always automatic. I want to open up a private foundation, but now there are other alternatives, and the best alternative is a donor advised fund.
Okay, thanks, Mandy. And going in a little deeper into the differences between a private foundation and donor advised fund, we did mention earlier that a donor advised fund has a lot of similarities to a public charity. It is considered a public charity regarding the increased deduction that you get to 60%. It's considered a public charity related to record keeping, meaning once you give the donation to a donor advised fund, and receive a receipt for that, your obligation for record keeping has come to an end, and anything that you do advise later to be distributed at a later point, you don't have to have a record of that. That's the requirement of the organization's donor advised fund. Additional drawback of a private foundation has a required amount to be distributed, a certain percentage of assets each year that has to be distributed to other charities. Donor advised fund does not have that restriction at this point.
So we do have a question. Let me just cut in a second, Yisrael. So we do have a question. Why would it be better to open a private foundation if the limit is only 30% versus 60%? So obviously that is, just to answer myself, that is one of the drawbacks of a private foundation. Also, maybe one of you can get into this. From the DAF, when you're actually recommending the donor advised fund to give to a charity, are there limitations on that end where a private foundation would be better, or those are equal?
Okay, and that end, the limitations are practically the same. For the most part, you have to give to other public charities from either of them, and it can be to another private foundation. It can't, for the most part, be to a foreign organization. There are circumstances when you can give from either to a foreign organization. However, there's more oversight requirements, and most donor advised funds would not allow you to do it. And if they do, it's to specific organizations that they have oversight agreements with, where they can check in basically and see what the money was used for.
Okay, there's another question we have is, can a DAF make independent investments of their assets? And if they do, and if they can, what's to protect against the loss of principal of those investments? So I just want to plug, since I'm not, separate company, Equinim, even though the two other panelists are from Roth&Co, I'm pretty sure people are aware. I think it's public knowledge that that OJC does use Roth&Co to do their audits. And I'm sure that's part of it. But if any, you can go into more detail on how to protect against the loss of principal of if and when that donor advised funds invest those money that the donors are giving them to hold.
Okay, so I guess I'll take that. For the most part, since OJC does use Equinim to run their investments, I don't expect that to happen. However, for the most part, donor advised funds would only allow you to invest in secure investments where there's minimal risk for that. If there is some downside, most donor advised funds would deduct that difference from your account. Some of them don't. They would just keep your balance equal. But since you get the upside of it, usually you'll get the downside as well.
I could try to provide a little bit of color here. So just like a regular bank, when you're giving money in a bank, they're normally making loans with your investments, and there's regulators and people looking out for it. Or an insurance company, they're taking your money and investing, and based on their actuary estimates, there's a certain amount that they have to keep in certain grade of asset classes that are secure based on their actuarial numbers. The same should be with any reputable donor advised funds, especially ones like OJC that use auditors and investment advisors like ourselves. So that would be my response. Are we done, Yisrael, with this slide? Can we move to the next?
No, I just want to expand a little on the benefits of a donor advised funds a little more. It is something that has become over the last few years more popular because of the benefits we discussed already. And additionally, the proliferation of more donor advised funds, the ease of giving with it. Instead of having to write out checks to each individual, most of them have online platforms, apps. Recently, OJC has pioneered, and others as well, the credit card-like cards where you can just swipe your card and it's considered a advice to the organization to distribute to that to the recipient organization contribution. They have these certificates which work like checks almost, which makes it easy to give out the funds, and by using that, you can practically deduct every every dollar of tzedakah or anything that you've been giving, at the end of the year, you'll get a record of everything that you gave for that year, and all these small amounts can really add up, and it makes it much easier to deduct everything as opposed to a private foundation, besides the increased donation that we discussed before.
Okay. Could you reimburse yourself? Another question that came in. Could you reimburse yourself from the DAF for charity that you already gave outside of that donor advised fund?
No, that's not allowed. The donor advised fund is a public charity. Once you put the money into the donor advised fund, it's considered as if you gave it already to charity. It's not your fund. The only thing you retain is advisory privileges. And those advisory privileges are restricted to donating to approved charities.
Okay, let's move forward. I do have a lot of questions populating. Maybe we'll save some time for Q&A afterwards, depending on how long we want to go. But let's if we don't answer your question live, we will try to get back to everybody individually on the chat function.
All right, so I'll take it from here. So, and I think I did see a couple of questions that kind of relate to this, which is overlapping years. So there were a couple of questions that came through as far as that's concerned. So that's actually one strategy, and we get that question a lot here as well, which is I generally don't itemize. I use a standard deduction. Again, going back to the example I gave earlier, which the standard deduction in that case was $27,000, and I don't have enough. I don't give enough charity, or my mortgage is not that high, and therefore I generally do not. I generally just go with the standard deduction. So one strategy that does save in taxes is by combining years, meaning that if you're a person that gives $10,000 of charity each year, potentially you give $20,000 of charity in 1 year and you skip a year. And by doing that, you have a bigger deduction in 1 year that you actually could take advantage of, when potentially you're not taking advantage if you take only $10,000 of charity per year. Similarly, if somebody has 1 year where they make a lot of money and they have uneven income, we've seen people do this as well. In the year where you make a lot more money and you're in a higher tax rate, you make sure to shift more of the charity to that year, so you'll get a better benefit.
And this was, by the way, in that point, that was the difference I was mentioning earlier of having sort of two different accounts of types of charities, and let's call it tzedakah and charity, that you don't have to necessarily through the donor advised fund or through other entities like that, whether it's a private foundation, you could get that charity deduction in that high tax year and just give it to the end charities over time. It doesn't have to be given at the same time, and it could accumulate. I will talk a little bit about investing wallets there as well.
Right, and that's really the last point, which is related to the first couple of points. So thanks for pointing that out. Which is that the challenge always is, I have a year where I'm in a high tax rate. I want to maybe put in a lot of money in 1 year, but I like to distribute charity over, whether different obligations that you have, or things that you've given charity in the past, and you want to continue to contribute over a couple of years. So by using a donor advised fund, that gives you the flexibility of getting deduction in 1 year. The year that you actually put the money into the donor advised fund, that's when you get a deduction. Same thing with the private foundation. And then you could distribute it out over a couple of years. Another tax strategy that we've seen people take advantage of is donating appreciated securities. This is just an IRS loophole that's available, and it definitely is very advantageous, which is that, generally speaking, if you think about the way a person earns income, you earn income, you pay taxes, and then you give charity, which gives you a deduction. So it's a two-step process, but there is an advantage of donating appreciated securities, which is an example over here, is where you bought securities for $2,000, it's now worth $10,000. And if you would go ahead and first sell the investment at the highest tax rate, the tax rate is 20%. So you would have to pay taxes first, and then you would get a deduction afterwards. Versus if you donate the whole entire charity as is before selling it, you would get the full $10,000 deduction. And we just illustrated the difference. You would get you would actually donate $10,000 of charity, versus if you sell it and then donate it, you would end up with $8,400 of charity.
Is this just with stocks, just with equities, or any other assets as well?
So it's with any other assets, but do keep in mind, I think Yisrael mentioned this earlier, that this strategy only works with capital assets. But again, the capital assets are not limited to stocks. So if you have, let's say, a property which is considered capital in your situation, then that would work as well.
Okay. I know we didn't get into different trusts. There are some questions about a CRUD or a CLAT. And again, this is something where we could spend the entire webinars on a lot of the different subjects that are being asked in some cases. So I do want to mention again and highlight every person's situation is different. I can say about this slide specifically, at our firm and at most firms, if you do have appreciated securities, this is a go-to strategy, especially if you have some type of if it's not just through funds, but if you're indexing your portfolio, you have outliers on both the upside and on the downside, and you're able to donate those winners, get the full deduction. You could buy them right back. There's no wash sales on that end. And then on the lower side, the losing positions that are creating that entire index, you could do tax loss harvesting, other strategies from a tax perspective. It allows you the ability to accumulate wealth with paying very little, if any, of capital gains and getting deductions on the income side as well, by gifting to charity. And it's interesting because a lot of the wirehouses, or if you see a lot of the presentations, everybody talks about tax loss harvesting, but especially in our community and for people that are really charitable focused and charitable, in general in their lives, this should be a really core focus to an overall investment strategy. Anything, Yisrael, that you want to add to this slide, or we could spend, I think, 5 minutes or so, 5-10 minutes, and go through some of the questions that were compiled. Or do you have anything to add as it relates to this slide?
No, I mean, I did see one question that's somewhat related. What's about non-capital asset? I believe it was in the earlier slide. A non-capital asset, you get a deduction of 50% for a public charity and 30% to a private charity. However, you don't get the benefit of fair market value, meaning for, like we discussed, for capital asset, you get the even though you bought it for much less, you get the deduction based on fair market value.
Okay, how about the deduction of appreciated inventory to a public charity? Is that considered like an asset that you're mentioning, a capital asset, or is inventory different? That was also a question that was here.
Well, so inventory is not considered a capital asset because it's used in the regular course of your business. That would be a non-capital asset, and you would not receive the increased deduction, and it would be limited to the lower amount.
Okay, someone's asking a difference about giving the charity. So from the donor perspective, of either it's from a business or given personally, I could say that obviously, again, that's outside the scope of this webinar. That's what we're talking about here, about really speaking to your own specific situation. What's the tax, rates and brackets on each one individually? There are obviously benefits as a business that can get from gifting to charity, so as individually. How about recommending any specific DAF or any specific donor advised fund was a question that came in.
So as generally speaking, most donor advised funds are pretty similar. The big ones, Fidelity and that are out there. They're all very good. They're more within the Jewish community, have more ways of distributing out charity, which makes it easier somewhat for our community giving, but all of them are pretty good. OJC obviously worked hand in hand in Roth and make sure that they do everything per the law, and everything is signed off by by their attorneys and their accountants. However, most of the others also have the bank cards and certificates and websites. So I would say any of them, just you have to look into the differences and make your own decision.
Okay. Could you combine, this is back a few slides back, but could you combine private and public donations, and at what percent?
Okay, so that's actually an important question. We mentioned before that for cash to public charity, you get 60% of charity. However, if in any year that you utilize any of the other buckets, so to speak, meaning you gave to a private foundation, you gave appreciated stock that is limited to the lower amount, then your cash donation also gets generally limited to the 50% deduction. And that's important to note as well, that the 60% for cash was a temporary increase with the Tax Cut and Jobs Act, which is set to expire at the end of 2025. and then everything, cash will revert to the same deduction as any other asset, non-capital, where it will be limited to 50%. But as of now, it only gets limited to 50% your cash if you gave a 30% charity as well in that year.
Okay, let's
And
get
just
it. We
to
have
know
time
that the
maybe for one or two
60%,
more. Go ahead,
there's a
Mindy.
60%, just know 60% is expected to expire, but hopefully there's going to be a new tax law that passes that will extend it to, for another 10 years. So, but more to see on that in the future.
Right. So does tuition count as charity? I know that's probably a question we get a lot, especially if you're maybe gifting it from either directly to an organization or through a donor fund or something like that.
So that's an important question. Tuition, we mentioned before, intangible religious benefit. Tuition, even to a religious school, is not considered intangible. And if you pay someone's tuition, no matter if it's your family member's tuition, even your neighbor's tuition, is not considered a donation. It's considered as if you're receiving something in exchange, which would mean you're receiving an education, even though if you directly don't benefit, an individual is benefiting, and it's not considered a deduction. The only way to cover basically tuition and receive a deduction is if you donate to a scholarship fund, meaning certain schools would have a scholarship fund, or they just generally collect money in order to help out needier students that can't pay their tuition. But if it's designated for a specific student, then it's considered as if you're paying that person's tuition and you receive the benefit in exchange, and it's not tax deductible.
Excellent. So one final question, and I'll take it, is how do I donate stocks when I sell? Or so the point would be that you don't sell it. So OJC has a structure set up, and I'm sure other charities and donor funds and foundations as well, that you could actually transfer to them the actual shares. So you don't sell it. You gift them the actual shares. They go ahead and sell it. So the price at the value of what it's gifted to them at is what your deduction is going to be. So you don't have to sell it and get that capital gain. That's the key of where you can get that benefit. And on that note, I want to thank everybody for joining. I know, again, it's a busy time of the year. And thank you for taking the time to listen and be educated. Again, I do want to highlight, speak to your professionals, especially if something in the next couple of weeks for this year. There are many different strategies out there. I want to thank Mendy. Thank you, Stroll. I want to thank Roth&Co as a whole, as well as OGC Fund. A special shout out to the marketing team at Roth&Co. And everybody have a wonderful day, and we'll see you on another webinar in the future.
Thank you. Thank you, everybody.
Thank you, everyone.
Bye.